So now that we have gone through the various principles, let's take a question and see how all of these add together. So we want to look at a simple question here. You can take a screenshot of the question. Should be good with that. So let's look at what we have here. It's a very simple question, but let's see how it's detailed and how it is structured. Delta is an entity which is engaged in the construction industry and prepares financial statements to 30th September each year. Remember, always in financial reporting, corporate reporting, dealing with accounting standards, it's important we know the reporting date because that is going to guide various workings that we are doing. So our year ended is 30th September. The financial statements for the year ended 30th September 2015 are shortly to be authorized for issue. The following events are relevant to these financial statements. Let's go. On 1st August 2015, remember, the year ended of the company is 30th September 2015. Now we are told on 1st August because August, September. You want to be mindful. On 1st August 2015, Delta purchased a machine from a supplier located in a country whose local currency is the groat. The agreed purchase price was 600,000 groat, payable on 31st October 2015. All right. So what's going on here? We bought a machine from a supplier, but we're going to pay it sometime in the future. So it means this is credit purchases. Okay? But we are not buying goods. We are buying a machine, a property, plant, and equipment. So before you get excited, let's just put some pointers down. So Delta. Machine was purchased, payable in the future, so it's on credit. Now, if machine was purchased, remember, that machine will be accounted for in accordance with IAS 16, property, plant, and equipment on subsequent measurement. Again, if you remember in IAS 16, property, plant, and equipment, IAS 16 states that the initial cost of an asset shall be the purchaser's cost plus all other directly attributable costs incurred in bringing the assets to its present use. So to determine the initial cost of our machine, it's going to be the purchaser's cost, how much we paid for the asset, and all other directly attributable costs incurred in bringing the asset to its present use. Now, if the asset was bought on credit, that means that we are dealing with maybe trade payables. Okay? It was bought on credit. That means that is a monetary item, right? So on subsequent measurement, we must know how to deal with that. Whilst the machine is a non-monetary item. So the payable is a monetary item. The machine is a non-monetary item. Just to let you understand the flow of the question. Let's go back. The asset was modified to suit Delta's purposes at a cost of 30,000 during August 2015 and brought into use on 1st September 2015. Stay with me carefully. So after buying the asset, they had to do modification. So this modification cost of $30,000 is a directly attributable cost to be incurred to bring the assets to its present use. So this $30,000 must be included in the initial cost of the machine in accordance with IAS 16, property, plant, and equipment. All right? In accordance with IAS 16, property, plant, and equipment. Okay. The directors of Delta estimated that the useful economic life of the machine from that date of first use was 5 years. Okay. So it means that we're going to be depreciating this asset over the straight line method. IAS 16, straight line method. All right. Relevant exchange rate. So this is where the journey becomes very interesting for us. So let's see. We are giving exchange rate on 1st August, 1st September, 30th September, and 31st October. So it is important you understand what we're going to do. So let's start with our initial measurement and initial recognition. So initial recognition. When they bought the asset, in the question, we are told that on 1st August, they purchased the asset. So the date of purchase is 1st August 2015. That's when they bought the asset. So we translate or use the exchange rate at that date. What is the exchange rate? It's 2.5 groats to a dollar. So if 2.5 groats is $1, then the cost of the machine was 600,000 groats. So 600,000 groats will be how much in dollars? So we do cross multiplication, then we get the answer. Let me grab my calculator here, and then we'll work that out. So it means we're going to be dividing, okay, to get a initial purchase cost in dollars, or the purchase price in dollars. So that's going to be 600,000 divided by 2.5. So let's go. 600,000 divided by 2.5. And I'm getting $240,000. Stay with me carefully. So this is going to be the amount. So for this amount, remember we are told that they bought it, but they will pay on 31st October 2015. The year ended is 30th September. So they will make the payment after the year end, 1 month after the year end. So it's a credit purchases, like I said earlier. So if you want, our journal entry for this transaction will look like we debiting machine with that particular figure, 240,000. And then we credit the payables because it's on credit with a 240,000. All right? But we're not done, because we are told that the entity incurred a modification cost of 30,000. So really, for us to determine the initial cost of the asset, it's going to be different. So we come to the initial cost of the machine. So we slash in the currency sign. We bring in the purchases cost coming from workings 1, the 240,000. Okay. Then we bring in the modification cost, which is given in the question as 30,000. So our initial cost will become 270,000. Sounds good? 270,000. Now, stay with me. They said the asset was brought into use on 1st September 2015. Okay? So although they bought it on 1st August, because of the modification and all that, the asset was ready for use on 1st September 2015. So if anything, we'll start charging depreciation from that date. So that gives us the initial cost on 1st September 2015. That's our initial cost. Now, the machine, like we said, is a monetary item. So what do? We need to apply IAS 16 and depreciate it over the economic useful life given to us in the question for 5 years and determine the carrying amount. So let's go back to my slide. I'm just going to bring this and then present my slide as a continuation of this. So let me cut it and take it to the next slide so that I will get enough space here. So I will just say less depreciation. Now, the year ended is 30th September. The asset was ready for use on 1st September. So it means we will charge depreciation for only 1 month. So it becomes 270,000 divided by 5 years times 1/12. Does that make sense? 270,000 divided by 5 years times 1/12. So let's punch that out. 270 divided by 5 times 1/12. And I'm getting 4,500. So that is going to go to the profit or loss for the year, so that the carrying amount at the end of the year at 30th September 2015 would then be 270,000. That'll be 265,500. This is what will go on the face of the statement of financial position at the year ended. So you realize that at the core of the question, you are seeing a foreign transaction, but IAS 16 is also in town, and you must know how to do the calculation of the depreciation. And that was what I was mentioning on Friday, that the standards are, like that. They are together like that. So if you don't understand the principles like that, you will really have problems in that case. But again, we are not done. This is the monetary item, the machine. How about the trade payables? The trade payable of 240,000. At the reporting date of 30th September, they've not paid the money because they said they will pay it on 31st of October, 1 month after the year end, isn't it? So it means that the trade payable is a monetary item, so we have to retranslate it at the reporting date. So on 30th September, the exchange rate now is 2.0 groats to $1. So let's work that out. So retranslation of the trade payables. So remember, at the reporting date, or let me write the date down, at 30th September 2015. Remember, we still owe them how much? 600,000 groats. So if we are doing the translation now, 2.0 groats is $1. So 600,000 groats will be how much? So we now divide by 2 in this particular case to get our answer for the period under review. So payables, trade payables, which will go on the face of the statement of financial position, 600,000 divided by 2, and that's going to be $300,000. But stay with me. It's a liability. At the reporting date, we now owe the people 300,000. But at the initial measurement, we owe them 240. So that movement is an exchange loss and must be recognized in the P&L account. So exchange loss, which will go to profit or loss, will be the difference, which is the 300,000 minus the initial value 240,000, and that's going to be $60,000. So all these are our workings. All these are our workings. So the machine is a non-monetary item, so we apply IAS 16. The trade payable is a monetary item, so on subsequent measurement, it has to be translated. So now that we have all these together, what we do is then to go and extract the financial statements for the entity. So delta, statement of profit or loss, is an extract for the year ended. We just slash in the currency sign. What is coming here is our depreciation. Now we go pick up the depreciation. It's important you number your workings, right? So I'm going to say this is workings 1. I'm going to say this is workings 2. Then I will do the retranslation thing as workings 3, okay? Just for professional presentation purposes. So 4,500 for the depreciation. Then the translation, the exchange loss in workings 3, 60,000. They are all expenses, so you can leave them like that, and the financial statement is an extract, so there's no problem. Or you can put them in brackets as well, no P. It all depends on you in that case. Then, statement of financial position. So the statement of financial position is also going to be an extract. And then under non-current liability, non-current assets rather, we're going to bring the machine, the carrying amount of the machine in workings 2. We got 265,500. So we bring it up. Then we go to liabilities. Then under current liabilities, because this trade payable figure will be paid in just a month from now, it will be under current liabilities. So trade payables. And that will be in workings 3, the retranslated figure, 300,000. This is the answer to the question, and this is what we mean by treatment of transactions in foreign currency. Elizabeth said, "Sir, please, assuming it was paid for by end of September, how should it have been treated?" Okay. If this was paid for at the end of September, which is the reporting date, we will still do the translation and use the reporting date exchange rate. So let's say that, so let's just do the expansion. So let's say, like Elizabeth is saying, the payment was done on that date. That is 30th September. No P. Since we've paid for it, we will still account for the exchange loss in the P&L account, but now we've paid for it. So on the face of the statement of financial position, nothing will come here in respect of trade payables. Okay, Elizabeth, nothing will come here. So on the face of the statement of financial position, nothing will come because the figure is no longer outstanding. However, what is going to be happening is that we will still account for the exchange loss. It will still account for the exchange loss. The deal here is this, that once there is a difference between the date of purchases and date of payment, there has to be some foreign exchange movement. So if at the end of the year it's still outstanding, that is why you are seeing the figure on the face of a statement of financial position. If we have paid for it, on the day that we are paying, we will use the exchange rate on that day. They will compare the amount we are paying to the initial amount we recognized. If it has risen or reduced, then that will tell us about whether it is an exchange loss or an exchange gain, and still that will be recognized in the P&L account.